The second India Energy Week from 6th to 9th Feb brings together the entire energy value chain and will serve as a catalyst for India's energy transition goals. This marks the seriousness with which the government is focusing on the transition to clean, green, and efficient energy and the ecosystem which will get us there. As investors, this presents a unique opportunity to participate in the long term growth prospects of not just the energy sector, but all allied sectors too, like power, for instance. And in line with this, we'd like to present SBI Energy Opportunities Fund, a thematic fund which will cover not just traditional energy companies, but also new energy, power ancillaries, and in many ways, they're all opportunities which will eventually also power India's manufacturing ambitions. With me, I have Ruchit Mehta, our head of research, who will talk about why an investor needs to focus on this theme. Raj Gandhi, the fund manager of the SBI Energy Opportunities Fund, who will give us all the nitty gritty details of this scheme, and Bhavan Vitlani, fund manager of the SBI Infrastructure Fund, naturally, our resident infra expert who will talk about the extension of this theme to the power space and the larger infra impact. So, thank you very much for joining us. Raj, let me begin with you.
Sure.
Can you explain first what is the overall theme of the fund?
So, from an overall perspective, what we feel is that we are at a sweet spot where you can, there is opportunity to earn money on the traditional energy companies as we classify them, and also on the new energy side. So, on the traditional energy side, what we are seeing is that the profit pool there is increasing because of the policy reforms, the underinvestment in select elements of the value chain. So, versus them being seen as a terminal risk value business, we are seeing the profit pool there go up, much more predictability coming in there because of the policy and various external factors. So, that's kind of enhancing the value of traditional energy businesses. And then what we will see is in the leg two, as and when they put this money to use into transition, and so what we are seeing as transition business, old energy businesses will transition out, and that will be the second leg of value creation in there. And what is also happening is that on the traditional energy also, large part of the profit pool is right now not captured. Like oil, 85% we are importing, gas 50% we are importing, cooking coal 100% we are importing. So to the large extent, the profit pool is being captured elsewhere. Whatever profit pool is there, Coal India is selling majority of the coal at 80% discount to global price. So again, there is a limited profit pool capture here. On the power distribution side, the entire most of it is today with SEBs and loss making to a certain extent, which is incrementally getting privatized. So also what will happen is over time on the traditional energy side also there will be much more profit capture happening there, and it will be more market linked, more stable. So you will see that piece growing in value. And on the new energy side, India is very solidly positioned there in terms of having the trilogy of wind, solar, hydro. We've come to a phase wherein of late the round the clock renewable power bids are coming in at around 4 rupees, whereas thermal is now at 6. So it's a pretty exciting space right now, and will significantly grow in profit pool with PLIs and all coming. The entire profit pool will grow there. So essentially the theme that we want to play in this fund is having a barbell strategy wherein and make use of the sweet spot wherein traditional energy companies will make you money, new energy will make money as and when that sector grows in size, and then kind of balance out this and give a better risk adjusted return.
All right, fair enough. But Ruchit, if this space is so exciting, naturally the fund manager of a diversified equity fund will also be putting money in it, right? So for an investor, what is the argument for them to look at this particular thematic fund?
Sure. And that's a very interesting aspect because, this sector used to be a larger part of the index. I think it used to be north of 15, 18% going 20 years back. Today in the Nifty is just about 6.5 odd percent. Bulk of that is one large company. Uh, and that's the challenge that is there in a diversified fund. So typically a diversified fund manager will say, look, what is my benchmark? In the benchmark, what is the sector's weight? And how much risk do I want to take in terms of going overweight or underweighted? Now here, because this is a very interesting theme and has a slightly longer term time duration, because you're going to play the transition aspect from old energy to new energy as well. You have an opportunity to invest from a slightly medium to longer term perspective. The added advantage is that, as Raj was mentioning, the valuations are quite attractive. So, today I think the sector is roughly at about 40-50% discount to what the Nifty valuations are. Many of these companies are good dividend paying companies as well, high cash flow generating companies as well. So, there's a very interesting opportunity from that standpoint. So, from a portfolio standpoint, if you're looking at an sector to play out, right, as a theme to play out, that's where this new fund can come into play. We've had a lot of plays on consumption, manufacturing, etc., and to a large extent, many of those themes have played out. Valuations have gone up for those sectors. A lot of returns have been generated. This is one sector which has been underrepresented or underinvested by investors, and there the opportunity lies for us.
All right, so the child who has been ignored. Okay, but
Nice way to put it.
Raj, like you said also that a lot of money is going to move from the traditional aspects of a
Sure,
company
sure.
towards this new energy, right? So
Sure,
even NTPC we spoke about
Sure.
is going to have an equal representation board. So there will be so many businesses like this. So a lot of money will be going into capex for new energy.
Sure.
So what are the kind of growth expectations, therefore, that you have from the sector, since so much money will be, just held in capacity expansion?
Per se, as in, through past decade, what we've seen is generally, we've seen investors shy away from capital intensive sector, so to say. But I think issue was not with capex. Issue was that the cycle was so bad. We didn't see any of the capex earning ROCs. So issue really was not capex, but the ROCs that you earn on them. So which is where here, how we are placed, we are so competitive. As I was saying, on round the clock, renewable power is now cheaper than thermal power. So, issue never is capex. Issue is the return that you will generate here. And we are very uniquely positioned. China today gets a PLF of 23% incrementally on new, a lot of locations in Kutch and all. We are seeing 30% plus kind of PLF potential there. In this zone, but we will have the least cost of delivered hydrogen here. So what this essentially does is that for the traditional energy companies, when they have to transition to net zero and all, you will have a very cheap renewable power source, cheap green energy available, cheapest. So you will move up the cost curve. So this is where even the traditional energy companies we see have a tremendous potential to kind of this capex when you are globally and these are a lot of them are kind of cyclicals driven by global marginal cost curve, and we will improve further on the cost curve there. So I think here the ROCs that they will generate seems fairly reasonable, and we are competitively placed. So.
Yeah, you mentioned Kutch, and all of these are in such picturesque locations, right? You should probably include hotels and tourism in your basket in the allied space. But I have asked you so many questions, Raj. Probably I should have started with this earlier. What is old energy? Because I'm sure a lot of the people watching might be like me, not so good at investing terminology. So what exactly is old energy, and what kind of stocks and sectors does it constitute?
Sure. So, traditional energy or old energy per se is more fossil fuel related, wherein it has carbon footprint which we want to negate. So in that sense, and then what you have there out there is the oil value chain, which is upstream, refining, marketing, petchem.
Right.
Lubricants and such downstream plays. Then you have on the gas value chain, you have LNG importers. Then you have transmission, you have gas trading, and then CGDs going out there. Then on the power side, you have coal, then power transmission and power utilities and all. So I think rather than seeing them as black and white, as I was saying, a lot of these will transform, will use the cash flow. One their cash flow is going up. And plus they will transform. So the issue is if you don't have an opportunity to transform. Here we are very competitively placed in terms of, so our competitive advantage will in fact go up.
Right.
In terms of this is about
And conversely, new energy, therefore, will be all of this solar, wind, hydro, etc., right?
Yes, yes, yes.
So, how much of this is the old businesses transitioning, and how many pure play new energies? I mean, what is new energy by definition, and
Sure.
what does your universe constitute of?
Sure. So, from a new energy perspective, what it implies typically is it has a lower carbon or greenhouse gas emission footprint there. From that perspective, it helps us arrest global warming. So that is what largely that space is about. As we stand today, we're just scratching the surface there, in that sense that today, even globally, in fact, 85% of the key value chain on the solar is in China. On electrolyzers and all hydrogen, 50% of the key elements is with China. And with China plus one kind of strategy of late, we've seen people wanting to diversify out their sourcing base. So India stands a fairly competitive chance here, and also PLI schemes and all are being rolled out. So we see this space, eventually will kind of evolve. We will have more and more profit pool emerging and getting captured. So we intend to play through it as and when the theme kind of emerges.
All right, so the entire spectrum is available. Richard, I wanted to ask you, we also spoke, and Raj mentioned it also many times, is this whole concept of energy transition. What does it mean really?
Sure. It's a very interesting concept because this emerged truly from the whole focus on ESG, right? The whole focus on environment. And as Raj mentioned, that old energy or traditional energy has a higher carbon footprint. And through the years, there's been a lot of focus by consumers, regulators, and investors is that the companies that they are dealing with, whether as an investor or as a customer or they're regulating as a regulator, they should reduce their carbon footprint. And one of the aspects is that you need to then move to lower carbon footprint sources of energy, right? So on one hand, if you are, let's say, you're using power through a thermal power plant, it has a significantly higher carbon footprint. But if you can replace that with, say, a solar power plant, then it's a lesser carbon footprint, right? So that's the whole concept of energy transition, is to go from the old energy to the new energy. It's going to be a long time duration, and you'll keep hearing lots of news around it. But it's something that is going to be playing a very important role for both the existing incumbent companies as well as from an opportunity set of new companies emerging onto that space.
But for the incumbent companies themselves, what are the risks that this energy transition poses?
So the one primary risk is going to be that if you remain in the old energy business, then you're going to see over a period of time deteriorating cash flows because either demand is going to go off or you will see lower and lower price of the product that you purchase, right? Because as a customer moves towards the newer forms of energy, he's not going to be wanting the old form of energy. So that's the primary risk that's there. And what we've actually have noticed is that a lot of the old energy companies, both in India and outside India, have been focusing a lot about how do we transition. So that's the other part of the transition economy, right? That a large oil and gas producer is talking about how do I transition to new energy. So therefore, do I invest incrementally into a new oil field or do I invest incrementally into a plant that will manufacture hydrogen for us? Therefore, also invest behind solar plants, and you see a lot of these things. So the risk is if you don't invest, you will see cash flows reduce, and therefore value will drop. But the opportunity is to then invest the cash flows into the newer energy aspect and grow the business.
Yeah, so this is like the innovation, right, for this sector. And
Yeah.
any sector that refuses to innovate is going to find itself
Yeah,
on the losing
true.
edge on the other side. Raj, because we have so far, only dealt with primarily these oil and gas companies,
Sure.
right? And we have seen a lot of regulatory issues in the past. So is this a sector which is very prone to regulatory risks?
See, essentially, energy security per se is a matter of, it's a part of national security per se. So you will see, not only in India, maybe even globally, we've seen when oil spikes and there have been windfall tax in Europe and all post-COVID when oil spiked. So I think everywhere across, given the national security aspect of it, we do see some bit of regulation being there to varying degrees. And in India, given that fuel price was traditionally a bit more politically sensitive, there is a bit more of it there. But what's happening here is that of late we've seen that oil price compared to its own history has been fairly more stable, so to say. So that's kind of giving good backdrop, and we've seen the policy impetus that we've taken here to kind of even in traditional energy. Let's say today the petrol that you're filling in tanks is 15% ethanol blended. Diesel that you're filling with, they're starting off with ethanol blending there, so kind of reducing our risk. At a point in time, we had kerosene subsidy going to 40,000 crore of subsidy bill. Now kerosene consumption is down by 95%. They have stopped diversion. So on LPG, they have cut duplicate connections. DBTL has been put in place, so there is no diversion. So a lot of policy measures have been taken to kind of contain the risk, and we are seeing the results of it. That last 5 years, that the auto fuel subsidy is not there. We've been able to recover the gains and losses from the market itself. So I think with this kind of macro environment, and incrementally, if you see, we will move to more and more energy self-sufficiency. So frankly, as in to the credit of government, it's been a forced error kind of a situation, which I think over time that risk should come off and give a more stable kind of operating environment.
And like we've been saying, this is not just a sectoral fund, it is actually a thematic fund which is going to be looking at the entire ecosystem, and that's where Bhavin comes in. So Bhavin, in the ancillary space, what is the kind of opportunity that's there?
Great, thanks. So when we speak about ancillary, it's a very wide area of opportunity. Now, if you say a refinery or a power plant, you have companies which manufacturing boilers or turbines which help in generation of power or refining of the crude, and that the power which is being generated has to be transmitted to the end consumer. So the companies are manufacturing transformers or switchgear. All of this has to be automated now. Then automation as a companies which comes in. Mining is an important element of yours, and you have companies which are into construction equipment, supply of mining equipment. So the opportunity in case of ancillaries in the energy space is pretty wide, and this sector, because it is very technology intensive, we have companies which are sectoral leaders, and fairly concentrated opportunities are available in the energy space, especially in the ancillary.
Okay, so power will be a big part of this too, right? So one concern that some investors might have is that power stocks have already run up so much over the last few years, right? So is there any juice left, literally, so to speak?
It's a very fair concern, but it's what point of time that you're looking at. So power stocks actually after the 2007-8 time frame, where we overbuilt thermal power plant, and a lot of these companies resulted in the NPAs for the banking system as a whole. We had a lost decade. Now, when we look at last 1 year, we will see exponential returns in these companies. But on a 10-year basis, these returns are still subpar. Now, the question always is what from here? Now, as we have seen consolidation in the space, and equally important is that the growth is now coming. But we have seen a reasonable amount of time where we have seen double-digit growth in power consumption. So as the growth comes in, the sector being consolidation, yes, the returns what we have seen is actually sector coming out from severe undervaluation to close to fair valuation. There can be some bubbles in pockets, but as a whole, we believe the opportunity on a longer term still exists.
The picture abhi baki hai.
Absolutely.
All right, so thank you so much, Ruchit, Raj, Bhavin, for joining in, and all the very best.
Thank
Thank
you.
you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.